Good afternoon, ladies and gentlemen. I'd like to begin, as I try to be polite enough to do, by thanking the sponsors, Jay Martin and the whole group at Cambridge. I know from personal experience that putting on a conference like this it's an awful lot of work. It's herding cats. So I'd like you to join me in a round of applause for Cambridge and the employees. Thank you for putting this on. I don't know who gave me this speech topic, next big score, probably me, but I don't remember. So given that I have no earthly idea what my next big score is, what I'm gonna do is tell you about the way I'm positioning myself now in hopes of achieving this next big score. I know that everybody here is coming here expecting me to give you a 10-cent stock that's gonna go to $1 by Christmas. And the people who expect that, sadly, are going to be, as they have been in years past, very, very, very disappointed. I need to start with three premises that those of you who have heard me talk before are familiar with. The first is that in natural resource-based businesses, capital-intensive, cyclical businesses, you either must be a contrarian, which means to say that you need to buy stuff when nobody else is, or you are going to be a victim. Those are the two choices. Most people, for whatever reason, seem to choose victimhood, but there's no particular reason why the people who are here, who have taken time off their normal day to hear stuff like this, need to consign themselves to victimhood. Things that are unpopular are often good. Things that are popular from a financial point of view are almost always bad. Warren Buffett says that he became a multi-billionaire by being afraid when others were afraid and afraid when others are brave. Take that to heart. People look for a sure thing, which is okay, but there aren't any. Life is actually a series of probabilities. So if what you're waiting for is a sure thing, you adopt an investment methodology that goes like this. Ready, aim, 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 aim. At some point in time, you must fire. You must buy low in order to sell high. When the majority of the probability is on your side, you need to act. And if the majority is an overwhelming majority, as Buffett says, don't just bet, bet big. There is no certainty. The search for certainty is procrastination. There's always a range of probabilities. So let's talk something about probabilities. Let's talk about two probabilities that I see, which is germane to everybody in the room. I think that we are in the midst of, not approaching, but rather in the midst of two bull markets. Probably more, but two bull markets in subjects which I'm familiar with, which is to say natural resources. The first is a precious metals bull market, and I'll talk about why in a minute. And the second is an industrial materials bull market. And I want to give you a disclaimer. Everything I just said is wrong if we have a global recession or a global depression in the next 5 or 6 years. I'm going to tell a demand-driven story. But if the big thinkers of the world, the World Economic Forums, your prime minister, my president, all these morons, conspire to deliver us a recession or depression, you will really regret having listened to me today. So take all of that into account with regards to probabilities. But anyway, let's proceed. Nobody knows if we're going to have a recession or depression. I personally, by the way, for those of you who care, have accurately forecasted 17 of the last 3 declines in history. So I've gotten every one right and I've gotten 14 wrong. Two bull markets, jokes aside. Precious metals bull market. People say to me, Rick, when is gold going to move? And I said, well, 2019. I mean, gold's already moved. People say, the gold price has fallen $75. Right, after going up $800. I mean, give your head a shake. We're already in a gold bull market. The fact, I'll leave that alone. My experience has been that precious metals move up when people are afraid, and afraid specifically of the ongoing purchasing power of their savings and investment assets, particularly those dominated in the world's reserve currency, the US dollar. Sorry to my Canadian friends, but most people don't care about Canadian dollars. Investors worldwide care about US dollars. So, in order to decide if it's probable that gold and silver are going to go up, you need to decide, I think, whether it's reasonable, whether there is a probability that people will become afraid of the purchasing power of their assets in US dollars. I'm a US citizen. Most of my savings are in US dollars, and I'm scared. Here's why. Several reasons. The first, my apologies to those who have heard this before, but a lot of you haven't. The first reason why I think people are afraid, or if they aren't, they shouldn't be afraid, quantitative easing. Quantitative easing is the printing of new specious currency units out of thin air. If you did it, it would be called counterfeiting. But if Parliament does it, it's called, policy. It's still counterfeiting. I was shocked to learn the other day, and I don't shock easily, that 35% of all US dollars in circulation have been printed in the last 30 months. Now ask yourself, was this done to accommodate the liquidity needs of an economy that's 35% greater in the last 30 months? I mean, we had this little thing called COVID that sort of slowed stuff down. This is pure fraud. But it gets worse. Debt and deficits. Debt and deficits. I can't give you Canadian numbers, but I'm sure per capita they're even worse than US numbers. But the US numbers are horrific. As a species, if that's what Americans are, that's what most of the world thinks we are, we owe each other at the federal level $30 trillion. Write that down for fun. That's 30 with 12 zeros. Okay, that's at the federal level. But it gets worse. That's on-balance sheet liabilities. That's the bonds we've sold. Off-balance sheet liabilities. You're looking at one. I'm 69 years of age. That's Medicare, Medicaid, all the stuff that old people like me have voted for myself that young people like you have to pay for. That's what entitlements are. That's an exaggeration. $120 trillion in off-balance sheet liabilities. That's not some cranky old libertarian saying this. That's the Congressional Budget Office. They might get that one right, by the way. So let's add those two numbers, 120 and 30. What do you get? $150 trillion before state and local debt and before unfunded pension liabilities. And we propose to service this with a budget that's in deficit $3 trillion a year. How do you solve debt when the debt gets larger? But it gets worse. It gets worse. This is insane. Negative real interest rates. Anybody here think negative real interest rates is a force of nature? Any of you willing to forego consumption today, give me money so that I can spend it today and have fun, with the forthright promise that I will pay you back 5 years less? That's what negative real interest rates are. It's a promise that I will consume today, you will forego consumption today, and I will give you back less money. Does that sound like a good deal? Anybody here want that deal? By the way, I'll take it all day long. So the thing that really should scare somebody about the US dollar is negative real interest rates. Let me give you a little bit of arithmetic. US 10-year Treasury, the largest and most liquid market in the world, the security that all other markets are priced against. Here's the value proposition. You lend money to the US government. I'm not making a moral argument here, not that you should. You lend money to the US government. They pay you 3% a year in a currency where the purchasing power is declining by 8.5% a year. So the US government, for the first time in my life, is making a promise they absolutely will keep. They will cost you 5.5% of your purchasing power every year for 10 years. Jim Grant calls this return-free risk. For these three reasons, quantitative easing, debt and deficits, and negative real interest rates, many Americans are concerned, as they should be, about the ongoing purchasing power of their US dollar. Why hasn't this scared people more? History, I think, is the guide. Many of you can't take yourselves back to the late 1960s. Sadly, I'm old enough that I can. 1968, 1969, 1970, 1971, 1972, we had the same circumstance. We fought the war in Vietnam, which we lost. We fought the war on poverty, which we lost. The consequence of that is that we had very, very, very large debts. We had negative real interest rates. We had inflation. Inflation was raging in the US economy for 4 years before anybody gave a damn. They had lived through the decade of the 50s. They'd lived through the decade of the 60s. Halcyon times, wonderful times. Nobody was afraid of inflation until it bit them. People haven't been bitten by inflation yet. They've been through 40 years of benign economic climate now. My suspicion is after 3 or 4 years, when people's wage increases don't keep pace with inflation, when the purchasing power of people's savings continue to decline year on year, at some point in time, people are going to realize, I've been getting screwed. And when that happens, I think that the beneficiary is going to be precious metals, the precious metals bull market. People are free to disagree with me, by the way. God knows I've been wrong before. But when I talk about the range of probabilities, the idea that people are going to be scared because they get poorer every day, eventually that's going to take hold. And there's going to be two consequences of this, I think. In the US, I don't know the Canadian numbers, in the US, the market share of precious metals and precious metals related securities relative to all other asset classes, savings and investment asset classes, is 1/2 of 1%. 1/2 of 1% of all the savings and investment assets in the United States are denominated in gold and silver. The 40-year mean is 1.5 to 2%. So if counterfeiting, debt and deficits, and negative real interest rates operate to scare just a few people, my suspicion is that gold and silver will revert to their traditional mean, which is to say that demand for gold and silver will triple or quadruple in the largest savings and investment market in the world. Pretty simple? Certainty? No. Probability? I would say very, very, very high. When? I have no earthly idea. I don't know. Let's move on to industrial materials. Industrial materials here, the story is really threefold. The first is that there's almost 8 billion of us on Earth. Almost 8 billion of us. And there are more every day. And mercifully for humankind, at least the bottom half of humanity is getting richer, which is a very good thing. In the last 30 years, the poorest of the poor, while still desperately poor, are doing better than they were before. But still, there's work to do. 1.2 billion people on Earth have no access to electricity. 2 billion people on Earth have unaffordable electricity. All those people in those countries want to live like you. How many people here remember the bull market in materials in the year 2000 to 2010? A lot of that bull market was one guy, Deng Xiaoping, saying to be rich is glorious, taking 500 million people in China from rural penury to a lifestyle that sort of resembles the one that you resemble. The case in industrial materials is simply the advance of humankind. Marginal increases in per capita consumption spread over billions and billions and billions of capita, which is to say demand growth is inexorable. All those people want to live like you. They have a right to live like you. Increasingly, they have the ability to live like you, and they're going to compete with you for stuff. On the other side, as a society, we have been underinvesting in industrial materials for 3 decades. In the oil and gas business today, the International Energy Agency estimates that the global oil and gas business is underinvesting, deferring $1 billion a day in sustaining and new project investment. $1 billion a day. Now, if you underinvest, I'm using oil to represent all of industrial materials. If you underinvest every day, if you don't make sustaining capital investments, if you don't make new projects investments, an oil well isn't something where you throw water and fertilizer and it grows more oil. Every day you pump, your business gets smaller if you don't do sustaining capital investments. So on the one side, humankind is getting richer. On the other side, our oil fields, our copper mines, all these things. Christ, in the copper business, most of the good mines are my age, which is to say they're past their prime, right? They're long of tooth. But we haven't been finding new ones. We haven't been developing new ones. What happens when demand increases and supplies diminish? Anybody can help me with this? What happens to prices? Thanks. Absent a recession, absent a depression, the truth is that we are in 2 bull markets. We're in an industrial materials bull market, and we are in a precious metals bull market. So my next big score is probably the same as my last big score. The truth is I've done financial resources. That's not true. I've done lots of things in my life. I've done natural resources and financial services successfully. I've done other things unsuccessfully, which I won't bore you with here. But I think my next big score is going to be the same as my last big score. And where am I going? Right now, in the trade we're in, with prices falling on everything, the highest quality natural resource companies, the great big ones, have the best relationship of price to value, which is to say, right now, the top of the quality trail is the best place to be. I don't need to be in amalgamated moose pasture petroleums, given that Exxon is selling at a fairly low price to value. They're great asset allocators and they pay me a huge dividend. Similarly, I don't need to be in consolidated orangutan copper when BHP and Rio Tinto and companies like that are attractively priced. But that isn't where my next big score is going to be. The truth is that if I'm right about the direction of both precious metals and base metals, that the market will follow its predictable pattern, which is to say that the big ones, because they deserve to, because they're cheap, will move first. Then the next scale, the intermediate producers will move, then the developers will move, then the juniors will move. And the truth is that the best of the juniors are as out of favor as the worst of the juniors right now. The difficulty is that the best of the juniors have a great future, and the worst of the juniors will inexorably go to zero. It's important to remember that. So where am I going to be? Well, I'm going to follow that same curve. Right now, I'm buying investment-grade companies, but I'm wandering around this exhibit hall looking for the juniors who meet the test, looking for the people who are going to make me money 3 years from now, 4 years from now, 2 years from now, some number like that. What's really out of favor right now is high-quality exploration. Strangely, low-quality exploration, which is to say $10 million market cap companies with $1.98 in the till, and a bunch of narratives seem to be doing okay. They deserve to be extinct, but they're like cockroaches. You can't kill them. But the higher quality exploration companies, the people with a couple good drill holes in the ground, with a third dimension proven. Ironically, somebody drills a really good drill hole like Centaurus the other day and the stock goes down. I mean, this is a wonderful circumstance for somebody who wants to buy stuff cheap. It gets cheaper. But ultimately, I suspect that what will really work for me will be the prospect generators, the people who are doing the real out-of-favor work, the people who are generating the intellectual capital for the mining business, staking the projects, doing the preliminary work, and then farming out the risk to other people. I've tried to give you a real thumbnail tour about where I see the opportunity. How many issuers are in the room, by the way? I see a few hands. Listen, in most of my life, my real big scores have come from private placements. The difficulty in the last 5 years is that you guys have been too popular. And so you haven't had to come to guys like me and do real deals for real money. You've been able to get money from dumb people, and competing with dumb money is the dumbest thing you can do. It seems like some of that dumb money has gone to money heaven. If you're looking for a real investor and you have a real proposition, I'm looking for private placements. I'm actively looking for private placements. Part of it is incumbent on you to show me that there's some value. And the other thing is that the issuers need to relearn a simple word in English. That's warrant. It's spelled W-A-R-R-A-N-T. If you can't spell or offer warrant, please don't come talk to me. Do I have any time left for questions? Pardon me? I have a minute or two, which means I can answer one really smart question. Sir, you have a really smart question. Yeah, in truth, my next really big score is, for those of you who know me, you know that I've started and invested in banks over the years. My last bank was Everbank, which we grew from zero to $28 billion before we sold it to TIAA-CREF. So at 69 years in retirement, I'm celebrating retirement by starting a new bank. If anybody in the room isn't happy with their current banking relationships, I can't imagine that would be the case. But if you aren't happy with your existing banking relationships, get in touch with me. You can find me, rick@ruralinvestmentmedia.com is my email address. As I say, I'm starting a new bank with the same team that we built Everbank with. This is called Battle Bank because we'd like to battle for your business. Ladies and gentlemen, thank you very much for your time. Thank you very much, Cambridge House. Thank you, ladies and gentlemen.